something everyone really, really needs to know. When you get ready to open an account, there are two types of accounts you could possibly have. One is called a cash account, and the other is called a margin account. A cash account requires the client to pay in full for the securities that they have, that they buy in their account. You have to pay in full right then and there for any securities that you buy. If you have $3,000 in your account, you can only buy $3,000 worth of stock. Additionally, cash accounts have a waiting time called a settlement period. Now, in this settlement period, it takes 3 days before you are able to use that money again after your last trade. Okay? You have 3 days before that money that you used on that last trade will be available again. That is the settlement period. Example, if you take a trade on Monday and it's a $3,000 position, once you exit that trade, you have to wait until Thursday in order for that money to clear before you can trade it again. This is called the settlement period. It's similarly to waiting for a check to clear. So if you have a really small account, it really limits the amount you can trade because you continually will have to wait for that account to settle. Now, the solution to this is also the other option. That's the margin account. Now, a margin account, there's still a settlement period of 3 days. But upon signing the margin agreement with your broker, the broker will give you a credit for that same amount that you're waiting to clear, enabling you to continue to trade uninterrupted. Okay? Now, a margin account also gives you leverage if you so choose to use it. Leverage in multipliers of 4-to-1 intraday up to 2-to-1 overnight. Example, if you have $3,000 margin in your account, depending upon the stock, you can receive a multiplier of 4 times the amount. So if you have $3,000 in your account, 3 times 4 is 12. That broker will give you leverage of $12,000 of buying power to enter a particular trade. This is your current cash balance, $3,000 multiplied by 4. Or if the multiplier is 2, depending upon the broker, depending upon the stock. Some stocks are more riskier than others, so they reduce the amount of leverage they allow you to have on that. If it's 2, then 3 times the 2 will be the 6, giving you $6,000 of buying power to enter that trade, and so on. This gives you an opportunity to make some really large gains, and it also gives you an opportunity to make some really large losses. Meaning, if you lose this borrowed money, you owe that back to your broker. This is very important. Leverage. As of 2019, the Federal Reserve Board requires an investor to fund at least 50% of a security's purchase price with cash. You are required to use 50% of your money to purchase a security, and the investor may borrow the remaining 50% from a broker or a dealer. Okay, this is what I explained earlier. They allow you to give you a credit to allow you to continue to trade uninterrupted. There's still that settlement period, but they give you that credit. They also give you leverage, 2-to-1, 4-to-1, 6-to-1, that you can use as well. Warning, warning, warning. Twice as much money, meaning that you can lose your principal amount twice as fast. Borrowing on margin is very expensive. Some brokers charge several percentage points above the prime rate, which means you're paying a lot of interest. And this is something that we do not encourage. This is something that I do not want you guys to do, being that I'm strictly against interest. Also, when you have a margin account, you fall under what FINRA and the SEC call the PDT. This is another quiz. You see it highlighted right here in dark print. PDT, Pattern Day Trade Rule. It was designed to protect beginner traders with margin accounts from blowing them up. As it states, if you have less than $25,000 in your account, you are only allowed to trade a total of 3 day trades within a rolling 5-day period. This is what they instituted because the margin, the leverage, was blowing people up. So they instituted this pattern day trade rule. Because if you don't have over 25,000, you're really a novice anyway. So those 3 day trades within a 5 rolling day period is sufficient and enough for a beginner. Now, if you make more than 3 day trades within that 5-day period, you will be flagged as a day trader. And as a day trader, you must maintain a balance of over minimum $25,000. The reason I say over, because if you only got $25,000 in a trade and you hop in a trade and you lose, a point on it, now you're under the 25,000, now you're restricted again. So you want to give yourself some elbow room, okay? You could possibly get a warning, stuck in that position, and you don't want to do that. You're stuck in that position because sometimes it lasts a minute. Now, the benefits of a cash account, okay? Now, the primary benefit of a cash account applies to those who have small trading accounts, which do not meet the PDT requirement of $25,000. So one of the benefits of cash account, if you don't have $25,000, the PDT rule does not apply to cash accounts. And if you have the capital, you can trade as much as you like. But the drawback of a cash account, the biggest drawback of a cash account for traders is that after making a transaction in a cash account, the cash used must go through a settlement period, which is 3 days after the trade. So while the PDT rule does not apply to cash account to make several day trades in a week, you need to use a very small portion of your account. Like for example, if you had $1,000 in your trade account, and this was a cash account, to make 10 trades in a week, you have to only take a limit of $100 positions in each trade. That's a turtle pace, but it will get you there safely. Now, the benefits of a margin account. We're doing a comparison. The benefits of a margin account are primarily for traders who like to trade intraday, because the margin is extended to you by your broker, giving you more buying power than you have money in your account, and giving you a credit for the settlement period, allowing you to trade uninterrupted. Drawbacks of a margin account. The primary disadvantage of a margin account is that they're subject to the pattern day trading rule. If you don't have $25,000, they're only going to let you trade 3 times in a week. Typically, U.S. brokerage firms have a customer service line, and you can call to change your account quite easily. So if you wanted to start with a small account, and you started getting the hang of it, and you say, okay, I want to go add more money, switch my account over, it's just a simple phone call. Now, let's do a comparison. Margin accounts can use more money than you have in the account to buy more shares of stock. Also in a margin account, you can short sell stocks. That's something we'll cover later. That's when you bet against a stock. Subject to PDT rule, you can lose more money in it. Subject to margin calls, which means if you are using borrowed money and they say, listen, we need that right now because we don't trust you, you might have to give it up, and if you're in a bad position, you're going to owe them. You must have $25,000. If not, you'll be labeled as a PDT. Subject to interest charges if you borrow and hold this money overnight, which I do not recommend. Cash accounts can only trade what's available in your account. You can't short. Free riding rules, that's like that free commission. And can only lose the cash that you trade with, which is good. But it also has a settlement period for the cash. In summary, if you're opening an account under $25,000, think which type suits you better. You could use a small position in a cash account while you gain more experience. You could also use a margin account and just make 3 trades a week. Make 3 trades a week, but size up on your winners. Okay? Or you could split that money into 2 margin accounts and have 6 trades a week. Now, if you're opening an account over PDT, if you open an account over $25,000, you can use a margin account, so that you have as much ability to trade as much as you want. But keep in mind that anytime if you fall below that balance, you will be restricted. You can also still use a small position in, like you would in a cash account, to gain more experience. Now, what do I personally do? I personally have a margin account with more than 25,000 in it. So I'm over the PDT. I trade as much as I want, but I don't believe in interest. So I use the 25,000 to keep my account above PDT and so that I can trade as much as I want. Let me give you an example. I have 30,000 in my account, okay? The 25,000 I use to keep me above PDT. I trade the 5,000 as much as I want to. If I ever lose that 5,000, then I replace the 5,000, never allowing my account to fall below the PDT. This is what I do, and in smaller forms, I can recommend this for you as well.